Good afternoon, and thank you for joining us for today's webinar on the SEC's final Private Fund Advisor Rules. My name is Pat Palinko, and I'm a partner and co-head of the investment management practice at Seward & Kissel. Today, I'm joined by four of my fellow IM partners, Dan Bressler, Debbie Francis, Joe Morrissey, and Kevin Neubauer. As a preliminary matter, we note that the final rules were scaled back from the proposals, but we're only going to be focusing today on what made it to the final rules. So now we're going to turn to the quarterly statement rule. Debbie, can you provide us with a high-level summary of this rule?
Sure, thanks, Pat. So the quarterly statement rule requires SEC registered private fund advisors to distribute to the investors in the private funds a detailed quarterly statement that discloses various fund level information, including performance, the cost of investing in the private fund, certain fees and expenses paid by the fund, and then also compensation paid to the advisor. And in connection with the preparation of the quarterly statements, and in particular with respect to the performance information required to be included in the quarterly statements, the registered advisor is going to have to make a determination as to whether a particular private fund is a liquid fund or an illiquid fund, and we'll talk a little bit later about the definition of that term.
So what is the timing for distribution of the quarterly statement?
Sure. So it's different timing depending upon whether or not the private fund is a fund of funds or a fund that's making direct investments. And so advisors need to distribute the quarterly statements within 45 days after the applicable quarter end for the first 3 quarters of the year, unless the fund is a fund of funds, in which case then the statements must be distributed within 75 days after the quarter end. With respect to the end of the fiscal year, which would be the 4th quarter, their reports must be distributed 90 days after the end of the fiscal year, or with respect to fund of funds, 120 days. There is a particular special provision for illiquid funds that provides that if their quarter end numbers with respect to performance measures are not available at the time that the distribution is required to be done, then the advisor may use numbers through the most recent practicable date, which generally would be the prior quarter end. This is going to be important for illiquid funds, given that they may often have to obtain information from their underlying portfolio companies to the extent that they're investing in private companies, and this may be difficult for them to meet that 45-day deadline. We'll talk a little bit more about, where some funds will have, potentially other difficulties depending upon where they fit within the definition of liquid and illiquid. But this caveat doesn't exist for liquid funds. So if you do have private investments in a fund that's going to be considered to be liquid, this will be something the advisor will need to consider.
So a lot of our clients already provide quarterly reporting to investors. Would that type of reporting satisfy the requirements of the rule?
So this has been a question that we've gotten from a lot of clients already. Unfortunately, the answer is no. The quarterly statement rule has very specific reporting and a very specific methodology that the SEC is looking for advisors to use. And so, typically the capital statements that are going to investors on a monthly or quarterly basis, or other information that's being provided by advisors to investors, it's very unlikely that that information is going to satisfy what needs to be in the quarterly reports. And this doesn't mean that you can't continue to provide additional information, and likely advisors will because of this specified format and the calculation methodologies. But unfortunately, it's not going to satisfy this SEC requirement.
And, 2 follow-up questions that we know that we've received from clients already. Can the quarterly statement provide class-level expense and performance information for a multi-class fund? And I think clients are asking that question because they typically present performance and information in that format.
Sure. So the rule is very specific that it needs to be done at the fund level. So an advisor is going to need to report the information at the fund level, and then can also provide supplemental information and include information at a class level. Or if you have, opt-in, opt-out side pockets, you can include additional information for those investors as well, but it doesn't negate the ability or the requirement that really you have to provide it at a fund level as well.
Yeah, and one follow-up an additional follow-up, can an investor waive the requirement that the quarterly statement be distributed to that investor, and that would thus allow the advisor to kind of opt out of the requirement?
No, so they're not permitted to opt out, even if you've agreed to particular special reporting with an investor, and they're getting, their own reporting based on their own particular needs. Essentially for any fund that meets the definition of a private fund that Dan talked about earlier, so generally 3C1 or 3C7, then the quarterly statement is going to need to be provided to that fund, regardless of whether or not the investor would have consented to you not providing it.
So, as we've discussed, it seems that the quarterly statement requirement is adding to an already crowded landscape of competing disclosure and reporting regimes for registered advisors. So we now have these quarterly statements. They may have investor reporting, special investor reporting, marketing materials that have to comply with the marketing rule. How should advisors be approaching this at this point?
Sure. So as I mentioned, I think that, it's likely that the performance, information will be continued to be provided, as advisors have been doing it in, kind of general investor communications. The SEC has indicated that the quarterly statements are not advertising within the meaning of the marketing rule, which is somewhat helpful, but they're, both the quarterly statement rule and the marketing rule both come under the anti-fraud rules. And so, there is going to need to be an analysis, particularly to the extent that the methodologies required by the quarterly statements are significantly different than the methodology by which advisors are normally calculating performance for the fund, as to whether or not their marketing materials will need to be revised or reviewed in light of, ensuring that they're not going to be misleading to the investors, particularly if the numbers are going to be materially different one way versus another. So it is something that advisors are going to need to, evaluate once they look at, how the performance information is going to be provided on the quarterly statements, and then what they're typically providing to investors, whether that's on a general basis or, maybe more specific one-offs per investor requests.
So does the quarterly statement have a specified format?
So it does. So it's supposed to be done in a tabular format, and it's supposed to disclose each category of expense as a separate line item, rather than grouping fund expenses into broad categories that potentially could obfuscate the nature and or the extent of the fees and expenses borne by the fund. So this is even going to be more detailed than, potentially the fund documents or in audited financial statements, where you may have an other category or a professional fees and expenses category. Here, there's going to need to be very separate line items. And the SEC has also indicated that fee and compensation information must be presented both before and after the application of any offsets, rebates, or waivers.
And what is included in the private fund level disclosure?
So there's really two different categories. So the first is going to be advisor compensation. And here the rule provides non-exclusive categories of advisor compensation. So management fees, advisory fees, sub-advisory fees, if those are paid by the fund, any similar fees or payments, and then performance-based compensation as well. And performance-based compensation, as you may imagine, would include any incentive fees or allocations and any kinds of profits interest as well. One thing to note in relation to advisor compensation is that there also may be some non-advisory services that are provided by the advisor to the fund, whether that's legal or back office or consulting, that may, be included in the fund documents as fund expenses, but on the quarterly statement, they may need to be recharacterized as advisor compensation. And here, this will really just be a facts and circumstances analysis of those types of payments and how they're being done or reimbursed to determine whether or not they'll be included or listed as fund expenses or advisor compensation. And then the second part requires a detailed accounting of all fees and expenses allocated to or paid by the private fund. And so here, some of the examples given include administration, audit, tax, due diligence, travel fees and expenses, insurance premiums, salaries and benefits, if you have a pass-through expense arrangement or something like that. But here again, there's going to need to be a very specific analysis by each advisor of the actual private fund expenses that are being paid by the private fund, and then making sure that that list in the quarterly statements is done in a detailed way.
So can you address the cross-reference requirement that's in the rule?
Sure. So here, the quarterly statement must include a cross-reference to the relevant section of the private fund's organizational and offering documents that set forth the applicable calculation methodology. And here they're talking about the method used to determine the manner in which the expenses are calculated. And so this will be, again, something that advisors will need to take a look at their offering documents to see what expenses are listed there, and then also what is currently paid by the fund, and may need to evaluate whether or not any updates need to be made to their documents.
So our sense is that private fund expense disclosure may need to be updated given the cross-reference requirement and the applicable calculation requirement.
So it may need to be. I think the fact that the quarterly statement is going to need to include very detailed information, it may be that the fund documents don't get into this particular level of granular detail about particular fund items, or that the advisors have this information in other places, like their expense allocation policies and procedures. And we have seen that, during SEC exams, the examiners have been very focused on expenses, including whether or not expenses have been disclosed in the appropriate level of detail. And here, the release indicated that the SEC's concern, and one of the reasons why they adopted the quarterly statement rule, is because they want investors to have increased transparency about these expenses in granular detail, including the amount of those expenses, so that they're able to really give material consent to being charged those particular expenses.
Thank you. So there is a third part of the quarterly statement, the so-called portfolio investment table. Kevin, can you take us through that particular part of the table?
So Debbie noted before the obligation to disclose compensation payable by private funds to advisors. Advisors to private funds will also need to disclose any compensation payable by portfolio companies to it and its related persons. And these would include origination fees, management fees, consulting fees, servicing fees, director fees, or other similar fees or payments.
So don't fund documents often provide that amounts payable by portfolio companies to the advisor would offset future management fees? Why would there need to be disclosure of these amounts given those arrangements?
They do, right? So if the management fee is offset or reduced by the amount of this portfolio company compensation, the advisor doesn't materially benefit economically from the receipt of those fees, and there is that offset. But notwithstanding that, disclosure of this compensation, both before and after the impact of any offset or rebate, will need to be disclosed.
Thank you. So now we're going to address the performance information disclosure requirements. And Debbie, you had mentioned earlier that in connection with this disclosure, advisors will need to make a determination whether a private fund is a liquid fund or an illiquid fund. How does the advisor make this determination?
Sure. So here the SEC actually did provide a definition, and the two-factor test that the SEC provided to identify an illiquid fund is that it's a private fund that's not required to redeem interest upon an investor's request and has limited opportunities, if any, for the investors to withdraw before the termination of the fund. And then a liquid fund is any private fund that's not meeting that two-factor test to be classified as an illiquid fund.
And so where is this distinction relevant?
So it's relevant in connection with the type of performance information that's required to be disclosed in the quarterly statements. And that determination as to whether or not the fund is liquid or illiquid is supposed to be made at least once, no later than the time that the advisor sends its initial quarterly statement. And so the advisor doesn't need to make this determination continuously unless they have reason to believe that the status of the fund has changed, which generally should be, likely rare occurrences. And obviously, something the advisor will just need to evaluate with respect to each fund.
So there are certain types of funds or arrangements that I know are going to raise issues here. How are hybrid funds treated here, and how would side pockets be treated?
Sure. So there's obviously a lot of different definitions of what people consider to be a hybrid fund. But one thing that often people will look at in determining whether or not a fund is a hybrid fund is the types of investments that it's making in connection with the portfolio. And so if it's investing in, a number of private investments and public investments, that's a common definition of a hybrid fund. So it's worth noting that the SEC did not focus on the underlying liquidity of the portfolio positions, but instead focused on whether or not investors are able to voluntarily redeem from the fund. And so there may be funds that have significantly illiquid portfolios that actually will be classified as liquid funds based on this definition. And the same thing with the funds that have side pockets, typically their investors have limited redemption rights only with respect to those portion of the assets that have been side pocketed, but generally are able to redeem the vast majority of their capital in those funds. And so it's likely that those funds are going to be classified as liquid under the rule.
Thank you. So because the performance metrics required to be disclosed are so specific, we're just going to walk through those disclosure requirements. Debbie, can you handle the liquid fund requirements?
Sure. So here, the annual net total returns for each fiscal year over the past 10 fiscal years or since inception, whichever time period is shorter, needs to be included. The average annual net total returns over the 1, 5, and 10 fiscal year periods, and then the cumulative net total return for the current fiscal year as of the end of the most recent fiscal quarter covered by the quarterly statement. And all of this, again, would be done at the fund level.
And so this is the return of the 1, 5, and 10 year performance metrics, right?
Yes, advisors may have escaped it under the marketing rule with respect to private funds where you didn't need to provide this, but it is now back.
Kevin, I think you're going to walk us through the illiquid fund performance disclosure requirements.
Yeah, so for an illiquid fund, an advisor will need to disclose a number of performance metrics, and they'll need to be disclosed both before and after the impact of a subscription facility. In other words, indebtedness that's secured by the unfunded capital commitments of the private fund's investors. So the performance metrics are gross IRR and gross multiple of invested capital, net IRR and net multiple of invested capital, and then gross IRR and gross MOIC for the realized and unrealized portions of the fund, with the realized and unrealized performance shown separately. They'll also need to show a statement of contributions and distributions that present all capital inflows the private funds receive from investors and all capital outflows the private fund has distributed to investors since inception of the fund, with the value and the date of each inflow and outflow included. And then finally, they'll need to show the current value of the private fund as of the end of the reporting period they're reporting for.
So actually, question is for both Debbie and Kevin. What challenges or issues do we see for advisors presenting the specified performance for liquid and illiquid funds?
Sure. So one thing that I think we've noted is just the potential for inconsistencies in the type of information that advisors are already providing with respect to the private funds. And here, the fact that this is fund level performance rather than, the often used kind of day one investor performance, this is going to create some issues for funds, particularly that have maybe multiple fee arrangements or multiple classes and side pockets and liquidating accounts, and how that fund level performance will need to be determined is going to be something that will need to be thought through. The SEC here did not provide any guidance on the calculation of performance or how that should be done, so that's another kind of undefined term from them. There also may be some issues given how far back the calculations need to go with respect to the fact that some advisors for certain private funds, including maybe sub-advisors, may not have sufficient records to calculate this from inception. There's also a requirement with respect to disclosing the criteria used and the assumptions made in calculating the performance, which particularly for advisors that have a significant amount of private assets, may require them to include a lot of detail about their actual valuation procedures, how those private investments are being valued, the frequency of that, when they're switching from, holding something at cost to fair value. And these are things that are typically usually just covered in valuation policies and procedures and may change over time. And here there's going to need to be a fair amount of detail in the quarterly statement on those particular items. So those will be things that, advisors will really need to think about in coordination with various parts of their firm.
And I would add to Debbie's point earlier about how the performance may be calculated in a manner that's different than how the advisor calculates performance to comply with the marketing rule or under the marketing rule in their materials. That's probably going to cause a fair amount of frustration, I would imagine, from finance groups and CFOs throughout the industry who've just spent a fair amount of time over the past year or so making tweaks and changes to the way they calculate performance information to comply with the marketing rule. The other challenge I might mention too is with respect to the requirement that all capital inflows and outflows since inception of the fund are reported. That may be a record-keeping challenge for some advisors who don't have those records handy, particularly for funds that have been operating for a while.
So what should private fund advisors be doing now to prepare for the quarterly statement requirement?
So as we mentioned, there's a lot of, changes in this rule compared to, prior practices by advisors. And so the first thing is really just to familiarize themselves with the requirements of the rule and really think about how it's going to apply to each of the private funds that it manages, including, funds of one or others where there may be some special issues. And so, recognizing that even though this is an 18-month compliance date, that there's going to take some time and coordination among various parts of the advisor's firm to produce and distribute these quarterly statements. So, likely finance, compliance, legal, investor relations, and that there may need to be some outsourcing as well, potentially to third parties, and whether that's, administrators or, auditors. And again, if you have private positions, potentially maybe even some third-party valuation agents. Then, advisors should really take a look at each of their private funds' organizational and offering documents and look at things like expense disclosure, not just, the expenses that are actually disclosed, but also, information about any calculation and methodology in relation to the allocation of those particular expenses. Reviewing any side letters to determine whether or not there are provisions included in those that maybe are not in the fund documents in relation to fees and expenses, or again, whether, as Joe mentioned, there are some informal arrangements with certain investors that also have, special fee and expense provisions that maybe haven't been documented, but are, being implemented by the administrator. Reviewing any expense allocation policies and procedures and valuation procedures, to indicate whether or not any changes need to be made there, or, whether or not this information is going to need to be included in the quarterly statement and what level of detail will be provided about that. And then just making sure that, all of the information required as far as books and records in relation to the quarterly statement preparation is going to be kept by the advisor and how they're going to do that.
Thank you, Debbie.